Chancellor Rachel Reeves is considering proposals to harmonise or equalise capital gains tax rates with income tax rates. In this video, I'm going to share with you why this is grossly unfair, madness for property investors, and completely nutty for the UK economy. If you're new to this channel, make sure you subscribe, hit the bell icon. We put out 3 to 4 videos each and every week, all dedicated to keeping you on top of your property investing game. So smash that subscribe button right now. Okay, the lefties always raise this hoo-ha. Income tax rates are higher than capital gains tax rates. But really, comparing the two is like comparing apples and oranges. If you're in a salaried job, you have an income and you pay income tax on that. Capital gains tax is something completely different. You put up some capital into an asset or a business, and as that asset value grows in value, you are taxed on the growth of that asset. The lefties' very simplistic argument is basically whether or not you make your money from labour or whether you make it from assets, growth in assets, it doesn't matter, the tax rate should be the same. There are a whole bunch of reasons why this is complete nonsense, not just in terms of fairness, but also for the impact on growth of the wider economy. And what seems to be a mystery to me is why there's very little debate or discussion on the really basics of this whole argument. So if I'm getting a job somewhere and earning a monthly income, the theory goes that I'm not really taking any risk. It's my employer's risk in terms of the business and all the rest of it. I do my job, I turn up every day, I do my thing, and I get paid. If I'm putting my capital up, then that capital can be wiped out to zero, and potentially, if things go badly, everything else I have can be lost. So there is an inherent greater risk involved in investing capital than there is in producing income from labour. And if there isn't enough reward for taking those risks, then people will be deterred from doing so. The other thing that is completely ignored is, let's say you're putting in £50,000 to buy an investment property. Well, where has that £50,000 come from? It hasn't been magicked out of thin air. It is money that has already been taxed because you've got it from some other source. It's already been taxed, and it's that capital that you're putting in to an investment. Now tell me what you think about all of this. Leave your comments below. If you're liking this video, smash that like button and share it, because more people need to be aware of the issues and the dangers of equalising CGT with income tax. Now here's the unfairness of it. If you buy a property for £100,000 and you hold it for 10 years, if during that period there has been 4 or 5% inflation every year, then any growth in value over that period of time, it's fine for that growth in value to be taxed at a certain rate. But the amount of growth that was inflationary growth should be deducted from the tax paid. So as a simple example, if you've had 5% inflation and 5% capital growth in an asset you've held for a couple of years, then you will be paying tax on inflationary growth. Now, years ago, there used to be an indexation allowance on capital gains. So you would have an asset, it would grow in value, and you would have indexation relief for inflation during the time that you've held the asset. Now, this indexation relief was removed and the CGT rates lowered. But that was fine during a period where there was comparatively low inflation. But to suddenly say, well, we're going to equalise CGT with income tax, but not take into account inflation, is completely unfair. And that sort of regime exists in, I can't think of any major country where that sort of regime actually exists. So for property investors who hold properties in their own name, the CGT, the capital gains tax rate payable, is already higher than if you held other non-property assets which experienced a gain. But compound that with unincorporated landlords and the Section 24 rule where you're basically taxed on your mortgage interest, you can see that properties in your own name would not be really worth holding if CGT was raised even further. Now here's the thing for the wider economy. When capital gains tax rates are high, what it means is that people that hold assets are reluctant to sell them because capital gains tax is paid at the time these assets are sold. So what happens in the economy is that people hold on to assets for longer than they should, and we are living in a capitalist system, and capitalism works because the capital in the economy is meant to be deployed in the most economically active place for it. So if people are just holding on to their capital in certain assets for fear of paying the capital gains tax and not recycling it through multiple avenues, then that in itself is not good for economic growth. We seem to just go around in cycles. Politicians seem to have memories like goldfish. It's not as though any of this hasn't happened before. We have had periods where there have been very high capital gains tax rates, and exactly what I am talking about has actually happened here in the UK. And then, of course, capital gains tax has been reduced, and the effects of that has stimulated growth in the economy, has stimulated investment in the economy, made the risk-reward equation better for not just property investors but all sorts of investors, and that has fueled growth. But what amazes me about this whole discussion about equalising CGT rates and income tax rates is most commentators, particularly in the mainstream media, seem to think of them as being the same thing. But they're not. It's fundamentally different. Income is generated pretty much at that time and has far less risk associated with it. Whereas capital gains is generated over a period of time. There is inflation over that period of time. That has to be allowed for as well. And also, investing capital is basically previously taxed money that has attached to it a risk for putting it into an investment, and that needs to be accounted for. If there's no reward for the risk, then people simply won't invest. So you get these articles like in the Independent here where they talk about equalising CGT and income tax rates as though it's some kind of no-brainer. Well, it is a serious risk, not just to your wealth and well-being and all the rest of it, but also to the wider economy, not just for property investors, but all sorts of investors in businesses and people that invest and take risk with their capital. So make sure you get on the articles like that and comment and let them know your dissatisfaction, and also let me know what you think of what I've just said in the comments below. Now, articles like these are put out as sounding boards. It's kite flying by Rachel Reeves and her team to see what sort of resistance and pushback there is. And we guys need to be part of that pushback to say that this is complete madness. That's all for this video. See you guys next time. The Baker Street Property Meet is the UK's largest and #1 property investors networking event. The property market is going through monumental change right now, and at Baker Street Property Meet we aim to keep you up to date with the latest tips and tricks and insider tactics to help you keep on top of your property investing game and succeed in these troubled economic times. The Baker Street Property Meet is fundamentally about networking, because it's not what you know, it's who you know. And at Baker Street we aim to connect you with the people to make your property journey a monumental success. There's no better place to be to further your property investment journey than the Baker Street Property Meet. So make sure you're here, you're connecting with myself and Andrew Roberts, our expert guest speakers, and 300 passionate property people each and every month. See you at the next meet. Get your spot at bakerstreetpropertymeet.com.